The April inflation numbers show that prices did not jump significantly as President Trump imposed higher tariffs and then, in many cases, delayed them. But the longer term is still uncertain, and the market response to the back and forth over trade has been volatile, especially when it comes to the bond market. Our economics correspondent, Paul Salman, explains.
Yesterday, we achieved a total reset with China.
The news this week that China and the U.S. agreed to pause the tariff war was a boon for investors. So anxious of late that the president had already paused most tariffs last month.
We're getting a little bit yippy, a little bit afraid.
Yips, originally a golf term for anxiety on the links. The president was referring to investors in the bond market who buy and sell U.S. government IOUs called bonds or treasury securities. Here's longtime market maven Ed Yardeni to explain.
Well, treasury securities are the debt instruments that are issued by the U.S. Treasury to pay for the spending of the United States government that isn't covered by taxes.
Finance professor Laura Veldkamp puts it this way.
A bond is an IOU that the U.S. government issues, and it promises to pay the buyer of that bond back in the future for the money that it's borrowed with interest.
How much interest? Depends on a few things. The maturity of the IOU, 30 days, a year, 10 years, 30. That is, how long before the U.S. is obliged to pay you back what it borrowed. Expected inflation in the meantime. You don't want to be holding an IOU paying 2% a year, say, when inflation is, 5%, since you'd lose money every year. The likelihood the U.S. is going to stiff you and default. But ultimately, the interest rate depends on buyer demand.
If the buyers are really eager to buy U.S. government bonds, they might be willing to take them with a low rate of interest. But if U.S. bonds start to look less desirable for one of many reasons, then the interest would be higher.
Now, there's a key reason for the desirability of U.S. Treasuries, according to finance executive Doug Dachille.
Treasuries are basically viewed as having no credit risk. No one really believes that the U.S. government is going to default.
Plenty of countries have defaulted over the years, but would the U.S. ever default on its treasuries?
That's nuts. I mean, that makes absolutely no sense. We want to maintain the full faith and credit of the U.S. government, and the way the U.S. government does that is by paying off its debts without changing the rules.
So folks don't worry much about default, which is why Treasury securities, U.S. bonds, have long been considered among the safest of all investments.
U.S. government bonds have been a global safe asset since about the end of World War II. And what that means is that everybody trusts that U.S. government debt will retain its value.
So then why would investors get the yips and start selling their bonds, driving up Treasury rates that are tied to all kinds of consumer loan rates? Well, maybe they think inflation is going to jump because of increased tariffs, making foreign goods more expensive, and higher inflation would make today's bonds worth less than tomorrow's.
If the interest goes up on newly issued bonds, then the old bonds that are out there that still have lower interest payments become less desirable in comparison to those new bonds with the higher interest rates.
And that concern that interest rates would rise brings out the so-called bond vigilantes.
If you're selling the bonds because you don't like the policies you're saying, you think they'll be inflationary, there'll be even larger deficits, then you're a bond vigilante.
Yardeni coined the term back in 1983 to describe investors whose selling put pressure on the government to change its economic policies.
It's the vigilantes.
You know, if the sheriff in town isn't going to do the job, then the vigilantes will push bond yields up.
By selling. But in April, there was another driver of the yips, hedge funds, private pools of investor money, which use a lot of debt, also called leverage, to make their investments.
A bunch of financial institutions, like hedge funds, had used U.S. government bonds as collateral, meaning I'll lend you some money, but if you don't repay me back, I'm going to get those bonds that you have, because they're sure that those bonds will still have a lot of value in case you need to collect that collateral tomorrow.
Problem was, bond rates were spiking, so today's bonds were losing money and thus losing value as collateral. Lenders told the hedge funds, we need more collateral. The hedge funds appear to have begun selling their bonds to come up with it.
It's a vicious cycle because you lose money, you sell. As you sell, you lose more money. So you create this spiral of selling.
And so what we see is a rapid unwinding.
And that's what happened with Lehman Brothers, right?
That's exactly what happened with Lehman Brothers.
Which back in 2008 triggered a crisis so severe the government bailed out the next big institution spiraling down, AIG, and then drenched the financial system with cash. The recent concern? Because U.S. Treasuries are so critical to the whole system, another potential death spiral a la 2008. Dashiell, who studied medicine before getting into finance and led investments at AIG post-crash, says the fear of a near-death experience always lurks in a system like ours.
The markets generally work, but like your heart generally works. But every so often, in some people, you develop what's called ventricular fibrillation, and that's what a Treasury Secretary fears, because when there's ventricular fibrillation, there's no mechanism for the body to actually restore the heart to normal rhythm, and that's what happened with the administration. I would say that the pause on the tariffs was kind of like a defibrillator to try to stabilize what was becoming an unstable market condition and a disequilibrium.
And potentially a heart attack of the financial system.
Right, well, death. I mean, when you get into ventricular fibrillation, if you don't defibrillate the person, the person, doesn't get blood flow to the brain and they die.
Well, the risk of flatlining seems especially remote now that tariffs with China have been paused. And yet, bond yields have risen again. So even though hedge funds don't seem yippy, and today's inflation number at least was unexpectedly low, investors just aren't loving our bonds. Expecting future inflation, maybe? A Fed that won't lower rates? Whatever the reason, it will have knock-on effects for most of us.
Anybody with credit card debt, anybody with a home loan, a mortgage, your interest rate is probably dependent on some treasury rate that it's indexed to. So as the US government becomes riskier, as US government debt becomes riskier, it's not only going to be more expensive for the US government, it's going to be more expensive for households that have debt as well.
And on that happy note, Paul Solman for the PBS NewsHour.